in trading, it's not the only way to see historical price data or to see current price data, but using a chart and using specifically candlesticks, which is the most commonly used display method of historical price data, that's what is the common way of viewing and interacting with the market, especially for retail traders. So what you have are candlesticks. And again, candlesticks, they are a type of indicator. It's what has already happened. The candle prints as it happens. So it does not predict future movement, but it predicts, or it shows you what has happened or what is happening right at that moment. And every candlestick has anatomy, okay? And we're going to kind of dive into what that anatomy is and kind of get you really familiar with the parts of a candlestick. We're going to first look at this bullish candlestick here, and this is where price closed higher than the price it opened at. So any candle is bullish when the price closes higher than where it first opened, okay? And you have really kind of two different parts in the anatomy of a candlestick. You have the body, which in the type of, really common candlesticks, that's this solid part right here. That's called the body. And you have any of the upper and lower parts that are not encompassed in the solid body. Those are called wicks or shadows. So you have a lower wick here and you have an upper wick here, and you have that on every single candle. You may occasionally have a candle that doesn't have an upper or lower wick, but traditionally and pretty much all the time, you've got kind of those two anatomy parts. You have the body and you have, the you have the shadows or the wicks, and upper and lower shadows or wicks. And so in looking at this, again, this candle closed higher than the price that it opened at, and in our example continued to push up. And what we have is any bullish candle, the bottom right here is going to be the opening price because price moved up from there, okay? And then at the other side of the body is you're going to have the closing price right here. Okay, and you're going to have the high is going to be the very top of the wick, and the candle low is going to be the very bottom of the wick. And if you look at this bullish candle, what had to have happened is you opened right here. Price had to push down, and then price had to push all the way back up here to the high, and then price had to come back down to close right here at this closing line. So there was a lot of movement. It wasn't just that price started here and pushed up. Okay, it was that price, a lot happened. Price started here, moved down, moved all the way up to the high, and then came back to the close. In looking at candlesticks, there is a, we think of the visual representation of the candlestick, but the truth is it's a visual representation of a dollar amount. It's a visual representation of money. It's a representation of the price point at which that pair has been trading. And in this example, we're saying that price opened at $1.50, that price came down to $1.40, then price pushed all the way back up to $2.10, and then came down before this candle closed and closed out at $2. And that is every single candle on any time frame represents a movement of price. It is just a visual representation of price, and you need to wrap your head around not getting attached to the appearance of the candle, but the fact that numbers are moving. This is price. It is about the numbers. Don't get, locked into the fact of what the candlestick looks like at any given point. It's much easier and much better, and will send you quantum leaps ahead if right out of the gate you'll associate the candlestick with the number that, or the price that that pair is trading at, and not necessarily, again, the appearance of this visual charting. And it's the same thing over here. If we take a look at this bearish candle, any bearish candle is when price closes lower than the price at which it opens at. And we look right here, this solid part right here, this is the candle body, okay? And then we have the upper wick or the upper shadow, and then we have the lower wick or the lower shadow. And again, you have that same anatomy on any candlestick. In this case, price push down and then continue lower in our example here. And on a bearish candlestick, the opening is at the top because price is closing lower. Whereas on the bullish candlestick, the opening was at the bottom because price closed higher. And so this, in this example, this is where price is opening right here at this $2 mark. And we have price closing here at the other side of the body, okay? We have a high, this is the highest point at which the price reached, and we have the low here, which is the lowest point at which the price reached. And so we have an open here at $2, and we have where price pulled back a little bit right here to $2.10. And in our example, then price pushed all the way down to $1.40, and then pulled back and closed at $1.50. And then we have candlesticks where price continued to push down. So the anatomy, again, of a candlestick is the same at all times. And so let's get a little bit more of a picture into what those pullbacks look like when price is bouncing around in a certain price zone, and really kind of what's happening. So this next slide is going to give a lot of information for that. All right, check this out. So what we have in are candlesticks, and we have higher time frame to lower time frame. We have a candlestick right here that looked just like the candlesticks we were just looking at just a few minutes ago. Okay, and we're going to say that this candlestick is a daily candle. Okay, this is one daily candle, and each daily candle, just for informational purpose, to let you know, each candle opens at 5 p.m. Eastern Standard Time and then closes the next day. So this is a 24-hour daily candle, okay? And within that candle, we have the same anatomy that we saw at, our last slide. Because this is a bearish candle, we have the open right here at the top of the body. We have the body. We have the close, we have the candle low here, and we have the candle high here, okay? This is one daily candle, a 24-hour candle. If we move over, we get a little bit more information, because if we go down in time frame, we're going to look at the 4-hour candle. So one daily candle is made up of 6 4-hour candles. And what happened is we have the opening right here. We have where price opened. We're seeing this was the daily candle. So this is kind of a snapshot where you're diving in to see what really happened, in this daily candle, where you have price pushed up. We have this bullish candle and this bullish candle that pushed up to make this high of the wick right here on the daily candle. And then you have where price pushed back down, closed past where the opening is, created the body all the way through. This is the body here, and this is the part that created the body here, okay? You have the body. And then price pushed down to the low right here, and then price came back, pushed down again, and came back and closed right here for the close. So you see that in 6 candles, what price really did. You absolutely see that price came up, made this high, price pushed down, made the low, then price pulled back and came back right here for the close. Okay, and so every candlestick has lower time frame information that breaks it down even further. Okay, so let's take a step further. So we do have this 1 daily candle, and if we take that 1 daily candle, it also is made up of 24 1-hour candles. So this is the 1 hour time frame right here that we're taking a look at, and you have the opening price right here that also coincides to the opening here, that also coincides to the opening here. So right here on the 1 hour chart, we have the open price right here, and we see that price kind of sat right here in this area for a minute, then price pushed up, created this high right here, then price dropped all the way down and created this low right here, which coincides with the daily low here and coincides with the 4 hour low here. Then price came up all the way here and pushed back down to the close, which coincides with this close and which coincides with the daily candle close. And so all you have is 1 daily candle that you broke down and looked at in a 4 hour candle context, and then you broke down even further and looked at it in a 1 hour candle context. And we're going to take that one step further and look at it in a 15-minute candle context. And so all it's doing is giving you more and more and more information. You can look at the daily candle and know where price, opened, closed, where the highs were, where the lows were. You can know where everything sits. You can know where all of, the highs and lows are, but what you don't know is all of the internal workings and all of the tiny little details of what price did in the midst to make this one seemingly, direct move. So the daily candle just kind of simplifies that information that we're looking at over here on the 15-minute candles. And so here on the 15-minute, we see the open right here, which coincides, to the open here. We see that price came up, ranged for just a minute, pushed up, and made the high. Made the high right here, which coincides to this high, and the same high over here on the daily candle. We then see price came down, pushed down back to the open. See, now we're not seeing that very much, here, and we definitely don't see it, marked out in detail here. We see it came right back to the open, retested that price, came right back up, and then actually formed, the high, retested the high again before price came and bounced around, up, down, up, down, up, down, new highs and lows being created, pullbacks here and there. You've got price moving down where it pushed all the way down here. It retraced back up and then formed the low right here, which coincides into this low and this low and this low, until you then have price pushed it up right here, came back down again, price pushed back up, came down, and closed right here. And that coincides with this close right here, and this close right here, and this close right here. So you can see, depending on what time frame you are on, and depending on what your strategy is looking for, your chart can either get really clear or really convoluted. And certain strategies really don't necessitate you being on the 1 minute or 3 minute or 15-minute charts. I spent the first several years trading on the daily and 4 hour candles, and then I used 1 hour sometimes when I was looking for an entry to dial in, but my main 2 time frames were the daily and the 4 hour. Now the last year and a half, just because my trading habits changed, some of the pairs changed, the strategies, I love trading, and I love trading different strategies. I enjoy it so much. I now use the hour and 15-minute and some of the lower time frames for dialing in, entries, but I'm sitting at the charts. I have certain hours that I sit at the charts each day, several hours, that I trade, and that's it. And so I basically manage my trades. I don't do set it and forget it too often anymore. And in the beginning, I was doing the set it and forget it or managing it, once every couple of hours or so. And it's just preference and lifestyle and what you're able to do being at the charts. And so a lot of times strategy can dictate what is necessary information wise, but you need to know that the candlestick, when you see a candlestick that looks like this, its journey was actually more like this. It's never just this straight, it's not even this pretty, path. That's not the way it works. It kind of goes, it ebbs and flows. It's always putting in lower highs and higher lows and lower lows and prices making pullbacks and impulse moves on every single time frame. And so that is something that you are going to have to get familiar with.